Modern finance looks like a high-speed casino. We are surrounded by crypto speculation and frantic day trading, with screens flashing red and green in a race for quick returns. But sustainable wealth generation relies on a much quieter, counterintuitive reality. It is highly predictable and incredibly boring. The entire system is built on a single economic principle: the time value of money. This is the observation that $1 in your hand today is worth more than $1 tomorrow, simply because today's dollar can be invested to earn a positive rate of return. In 1930, economist Irving Fisher formalized this relationship between time, interest, and purchasing power. He tied the concept of earning interest directly to human impatience and the opportunity to invest, cementing it as a law of modern economics. Time is the ultimate financial multiplier. But before you can exploit the future, you have to mathematically secure your present-day survival. This diagram shows the 50-30-20 rule. Income divides into 3 categories: 50% for essentials, 30% for discretionary spending, and 20% for savings. That 20% block acts as an automated defense mechanism. It builds an emergency reserve, absorbing unexpected financial shocks. Keeping debt manageable and paying bills on time builds a strong credit score. That 3-digit number acts as a gatekeeper. A high score secures favorable terms and lower interest rates on mortgages and auto loans, mechanically lowering your baseline cost of living. Standardizing daily expenses engineers a stable runway, allowing time-based compounding to begin. With the present secure, capital can grow through compound interest. This means you are earning interest not only on your initial deposit, but also on the interest that money has already generated. It turns linear saving into an exponential growth curve. We use the rule of 72. Divide 72 by a 9% return, showing an exact 8-year cycle to double. Plotting a $2 daily expense at 5% reaches over $3,155 by year 30, showing massive divergence between cash saved and wealth generated. Sustained capital injections scale along a geometric curve when exposed to an extended time horizon. Generating those returns requires managing risk across 3 primary investment vehicles: cash equivalents for safety, bonds for modest stability, and stocks, which carry the highest short-term volatility but offer the greatest potential for long-term reward. You survive volatility through diversification. Like a vendor selling umbrellas and sunglasses, inversely correlated assets reduce risk in shifting weather. Index funds execute this perfectly. Instead of picking individual companies, you buy a fraction of the entire market, owning thousands of global companies simultaneously. These tools mitigate the impact of individual corporate failure, capturing the broad upward trajectory of the global economy. The market never remains static. Over time, rapid growth in one specific sector will warp your portfolio's initial risk profile, leaving you overexposed to a sudden downturn. This pie chart illustrates the mechanics of rebalancing. If a targeted 60-40 allocation drifts to 80-20 because stocks surged in value, you sell off the overperforming assets and buy underperforming ones to restore your original ratio. It feels wrong to sell your winners, but rebalancing mechanically forces you to execute the hardest rule of finance: buying low and selling high, entirely devoid of human emotion. These foundational principles of asset allocation and diversification are the exact same strategies recommended by peak institutional regulators to protect long-term stability. Rebalancing functions as an automated mechanism that turns market volatility into a tool for locking in gains. The final defensive barrier is protecting that compounded wealth from tax erosion and disaster. Utilizing tax-advantaged accounts like IRAs reduces your taxable income, while maintaining adequate health and property insurance ensures a single emergency doesn't wipe out decades of growth. The accumulation of wealth follows a slow, mechanical process of consistency. Mastering personal finance means surrendering to the predictable math of time, consistency, and compounding. It proves that true financial power is, by design,